Hi guys, welcome to my YouTube channel once again. Uh, yeah, it's your favorite boy, Technical Rexy, and I want to share the lights on a very interesting topic. So I'll be talking about FVG, what we all know as fair value gap. If you don't know what FVG means, it simply means fair value gap, as I've written on the screen. So what the FVG means is FVGs are areas of imbalance, inefficiencies. You understand that price, the way the market moves, it usually creates highs, higher lows, higher highs, higher lows when it's trending, which means supports and resistance are being created, demands and supplies are being demands are being supplied for, and then we also have in a downtrend where price is creating lower highs and lower lows, and then resistance are being broken, and then supports are being broken, rather resistance are being tested, continuation are being confirmed. So while this is happening, we can spot FVG on a higher time frame. After viewing all this on a particular time frame, we can still spot our FVGs on a higher time frame. And how do we spot our FVGs? Like I said, FVGs are areas of imbalance, which means we are looking for what? We are looking for gaps. We are looking for gaps in price, in the candlestick. We are looking for gaps. So what we are doing is we are looking for three candlesticks. The first one, creating the initial move, like a short price move. The second one, creating a stronger move. The candlesticks open and closes far beyond its open or far below its open, causing or creating an institutional candle. We refer to such candlesticks as institutional candles. So when you have this candle, you are looking for the third candle as well, which might create a wick in some extent, like this, a wick like this. And after creating these wicks, this wick might not or will not retest for a standard FVG to be found. The wick is not going to retest or touch the initial wick that was created in the initial candle. You understand? So the difference in price of the first candlestick and the third candlestick is where we are going to find our FVG, because the FVG is a gap, is an area of inefficiency, and it is expected that price is always going to come back to areas of imbalance, because for every demand there's a supply. So price is always coming back to areas of imbalance, areas of liquidity, areas of, you understand? So we are for ignore liquidity in this context. We are looking for gaps. That's the most important thing. So now, after these candlesticks have been confirmed, you've spotted your FVG. So what you are looking for is a retest in price to that area or that level, and this can actually give you a high probability entry, in a trade, because these areas are areas where smart money traders come in. You understand? So finding your entry around these areas can significantly improve your entries, your risk reward ratios. It can significantly improve it. So the fair value gap is an interesting area for price action, for price entry. So if you don't still understand how to look for a fair value gap, you can just listen to this video and open your trading view, practice with live market, look for fair value gap. Remember, it's very simple. All you are doing is you are looking for three candlesticks. when you have your 3 candlesticks, make sure that there's an institutional move, which means there's a long candlestick. And for the 3rd candlestick that was created, make sure that the wick did not balance the wick of the first one, creating a gap in between. It is this gap in between that we are looking for as our entry. So when you open this on a smaller time frame, you still see something like maybe probably a support, a resistance, a support again, a resistance, probably like that. And then most importantly, in most cases, you might see an order block, which will also be in the area of your FVG. You understand? That is on the smaller time frame. Couple this with Fibonacci retracement, and some other tools. It's just going to give you like a very crazy entry, a high probability trade, because you are trading like the banks. It means you are trying to make your entries like the banks. You understand? So it's actually the FVG. I wouldn't advise you to trade it alone. It's best you add it to your strategy, or just add it to some sort of confluence. You understand? So if we have to look for FVGs in live market, we'll be doing this. I think this is a great example. So like we have here, we have price. Okay, here, this is a great example. I already outlined one. So like we have here, we have price creating the initial candle, which is this bullish candlestick. And after then we have an institutional move, which is, remember, there should always be an institutional move. This is the bearish candlestick, which is signifying an institutional move. See how long it is, how far it closed below its opened. And then it created a 3rd candlestick. Now this 3rd candle, you can see it created a wick, but the wick did not even go to balance up the first candle's wick. So now this is our area of FVG. This is our FVG. This is our FVG area. So now in this area, we are looking for entries. So we are waiting for price to come back, retest, and show some sort of rejection. So as long as price shows some sort of rejection, it's a good entry. Some people would even couple this with shifting market structure before they can make their entry. But as you can see, this area is a strong level, and you see reaction of price from this level. You can see the reaction of price. First reaction, there was a retest. After the retest, a strong push to the downside. Second reaction, there's another retest again, creating some sort of double top, and push to the downside. Even if this push wasn't really that strong, but at least it was almost 0.786 of the initial move. So it's a good one. So I believe with this video we can understand the usefulness of fair value gap. I would advise us to practice, do a lot of practicing, and just practice. That's all you need, and that'll be all. Thank you very much.